Just first of all, want to thank everybody for taking some time out of their day today. We're going to do the presentation in a couple of different sections. So we're going to do it. Well, we're going to keep the informative section, the presentation, under 60 minutes. We'll try to keep it closer to 45 or 50 minutes. And then from there, we're going to allow up to a half an hour for Q&A. We're going to request that you ask questions through the chat function. So if, and many of you have probably done some of these, but it's fairly easy to navigate. So from there, we'll get started. And again, I want to thank you for coming. I also want to thank Ryan Bratfold and Jessica Fow from BrownWinick and NCP respectively for helping the neophytes, which are your panelists, put this presentation together. They put a lot of work into this, and just want to let them know how much we appreciate it. The other piece, kind of the rules for the road, I guess, is we're going to make a commitment to you not to use the words uncertain or unprecedented. We'll just leave it at that. I'm kind of tired of those, frankly, and I chuckle every time I see one in an email, probably about 30 times a day. So we're going to stay away from those. And I'm going to keep a tally. If any of the panelists use those words, we're going to make them donate $100 to a nonprofit of their choice. So from there, a quick introduction of myself. Eric Lohmeyer, I'm the president of NCP, and we've been an independent firm, current iteration, we'll say, for almost 15 years, and mergers and acquisitions primarily. I thought it's probably better if I let each of the panelists, as they kind of enter into their subject matter expertise, do a little bit of something about themselves, but I'll give you a fun fact, and I'll start with Brett Peterson. Fun fact of Brett Peterson: in his college football playing days, Brett got up to 270 pounds. That's a fun fact. So I think he's got a future career potentially in the health and wellness. So if you have any requests from there, feel free to shoot those to Brett. Fun fact about Zach Eubank: Zach and I both acquired puppies. We succumbed to the pressures of our families within the last year or so. And early conversations with Zach were, every promise from the family members were broken. I know Zach and his beautiful little puppy had some issues early on, but I'd say the first time Zach took his puppy on a hunting trip, it probably redefined the term "a man's best friend." So I think they're getting along pretty well now. Chris Sackett, I think he's one of the most responsive professionals I've ever worked with. But when you can't get Chris, he literally puts up the sign "Gone Fishing." This guy goes to some pretty exotic locales, and if you're not able to reach Chris, I can guarantee you that's what Chris is doing. And then finally, a dear long-term friend, Bill Brown. Bill Brown used to live right down the street, about a block away from me, in the Waterbury neighborhood, fun fact, and lived there for years with his family. But like a 1950s sitcom, had to leave our lovely neighborhood for somewhere out west because the music was too loud. So we'll leave it at that. Another fun fact. So where we want to start today, the genesis of this idea was really through BrownWinick. And that came into a lot of shared experiences that we all had, and worked together on a number of opportunities in the Great Recession, kind of that 2008 through 2011-12 period. At that time in the crisis, I think all of us, to a certain extent, were really writing the playbook on how to approach difficult creditor lender scenarios. And NCP, kind of for our efforts early on in that system was, I think it was right after Lehman. There's the phones, literally, you might as well have killed the phone lines too. Had quit ringing, and we did some research, some backdated, out of print publications on distressed investment banking. So we bought a couple of books. I had everybody take certain sections, and we spent some time trying to figure out how we were going to kind of succeed through the next crisis. BrownWinick, I think, and I know they leveraged some of the counsels of kind of the 1980s farm crisis, and were able to pull from those experiences. And both of our firms, like I said, had a lot of experience kind of writing our own playbook for what a recession, Great Recession at the time, really looked like. And I don't think any of us really ever wanted to dust that playbook off, but I guess the other side of that is we have a lot of successful strategies and knowledge through very real time and effective workouts and restructurings and recapitalizations that we've all been through. And so our goal today is how can we share both our knowledge and our experiences, firstly on behalf of stressed potential corporate borrowers. A lot of stressed balance sheets today. There are certain sectors. I had 3 different sections in the business section of the Wall Street Journal today. One was dairy, the other one was oil and gas, and of course the other one was hospitality. And I think that's just going to be a theme, unfortunately. Really in spite of, I think the federal largesse has been, very, very effective over the near term. But, this is the 3, 6, 9, 12 months from now. You're going to have a lot of businesses that unfortunately, again, due to the pandemic, that are going to be quite upside down. And so there's some strategies there. So 1, on behalf of the borrowers. 2, on behalf of the lenders. I think and I've been doing this for over 20 years. It's hard to believe, almost 25 years in the finance profession. And I think the institutional knowledge in finance has a due-by date or an end date for most people of 10 years. It's a fairly young industry. There's a lot of burnout for a lot of reasons, but a lot of times it's from the lender side. There are a lot of strategies that we've seen that are very, very effective, and we're going to impart some of that experience as well. And then thirdly, we know and see that a lot of these balance sheets, when it's upside down, there's a need ultimately for fresh capital and liquidity. And so really from the investor side, there's a lot of strategies and things that some of these things that we'll go over today for how to recap some of these balances and ultimately look for that win-win. So I think the next slide, Ryan, would be appropriate at this point. The most, this is probably, if you take anything away from the presentation today, it's probably this slide, and it seems like the most common sense, but for a lot of people, it's really counterintuitive. You're a borrower, you've got a lender relationship, it's gone sour, again, pandemic driven at this point in time. I think a lot of people's first instinct is contention. It's lawyer up and fight over covenants and meanings and extensions and those types of things. Our experiences are quite the opposite. So we think a successful workout, or even a best outcome, not always anybody's definition of success, but a good outcome or the best possible outcome, it starts with transparency and objectivity. That means on the lender side, that means from the borrower side, that means from the certainly the investor side. It's something that the more that we can really try to get to a collaborative standpoint, it is just a far better process, a more efficient process. Frankly, it's a less expensive process. It's a more timely process. It's really important. We got a nice picture of a cat down there, but this is not a cat and mouse game. And assignments and things that we try to enter into, if we feel like it's going down that route, or if we feel like it is a contentious process, we'll underwrite that quite differently. We really try to make it a collaborative deal. And then the last point, it's one of my favorites, and I forgot who I read this from years ago, but I believe it was a Texas oil man. And his quote in one of the many, many oil busts of the century, could be a commercial real estate developer. They go through a lot of these too. But if I borrow $1 million from a lender, that's my problem. If I borrow $100 million, it's theirs. That's a really important point. And that's when we say for a lot of leverage, especially in a corporate scenario, it's not like a mortgage where you've got readily identifiable collateral, fairly, a somewhat efficient process to work that through. This is a scenario for most of the companies we've worked with in the past. It's tens of millions of dollars or more in credits, and that's where the collaboration comes in, because it really is. I shouldn't have said it's their problem. It's our problem. It's a collective problem, and the ideal successful workout is one where it's really a least loss, or we try to get an optimal outcome for all parties. And a lot of times that means these businesses are worth a lot more alive than they are in liquidation. So. That's an important concept. Next slide, Ryan. I think some of this will be, some of these points will be familiar to anybody in the 5 stages of grieving, but this is something that NCP came up with internally going through, the last Great Recession, and we just thought how uncanny it was that the stages of grieving and the stages of a workout are so familiar. It always starts for denial. It's going to get better. We're going to come back. But again, as these credits kind of keep building, it's a great scenario from a perspective of what we're going through today. As the scenario keeps building, I mean, a lot of the answer right now is just putting more leverage on the balance sheet. Outside of PPP, which is a really good program, a lot of the answer, a lot of what people are working with now is just adding, especially the public companies, just adding additional leverage. But when your fundamental business is one that's going to potentially be stressed for a long time, that isn't necessarily a long-term answer. So today, I think we're in that denial and probably moving past the denial to that anger stage. Why me? Why now? Whose fault? Why so unprepared, et cetera. Before you even touch bargaining. Bargaining is when what we believe when the kind of the collaboration begins. And I think we're still very much in denial, kind of trending towards anger. I think bargaining from a kind of a macro basis is probably something we don't see until at least the fall, maybe the winter of this year under most scenarios. As you bargain and even when you're collaborating, there just comes a point when in certain cases there may be a truly a big bounce back or a V-type scenario. And frankly, in our experience, most cases, it isn't that pretty and it takes a lot of work to get there. And it's not what anybody hoped, it was going to be a year, 18 months ago. But, this is something that I feel, again, maybe 6 months from now, we'll be in a position where we get there. Then in the bargaining stage, a lot of times you'll retract to anger, certainly, depression, but ultimately the acceptance stage is hopefully, where we land. And in most cases, this is to the last point, our goal when we're successful, and I say we as a team, the lender, the borrower, the creditor, the recap side, the liquidity, certainly the advisors, we want to resolve these conflicts in the boardroom and not the courtroom. And this is a great time to turn it over to BrownWinick, Chris Sackett and Bill Brown, and they'll kind of walk you through some of the legal particulars of the workout process. So again, thanks for being here. I'll flip it over, Ryan.
Thank you, Eric. This is Chris Sackett speaking. One thing I should tell the audience is through a little user error on our part, you're probably seeing that every time somebody is talking that it says Chris Sackett. That was obviously Eric Lohmeyer with NCP. This is actually Chris Sackett, but we'll try and announce who's speaking so you know that. So I'm the managing partner of the BrownWinick Law Firm. A little quick overview. We're a business-based law firm, about 70 lawyers, and what we brand ourselves as a group that comes up with bold and wise solutions at pivotal moments, and that we want to be part of our clients' pivotal moments, which is particularly applicable in a workout situation. One of the things that I say about workouts is you really need people to be problem solvers and proactive business people. So despite the fact that my litigation colleagues probably wouldn't appreciate this, I will say that workouts are the playing field for business attorneys, not litigators. There will come situations where you do end up in the courtroom, but as Eric started out saying, it's really the boardroom that you want to make your hay in a workout. The other thing I like to say is, you need lawyers in this situation that are mediators, not gladiators. So that's a little bit about us. Ryan, could we go to the next slide, please? So this is probably the most important slide that I will cover. And you'll see that it doesn't have a whole lot of legal theory in it. And there's a reason for that. That's because, again, these are business transactions first and foremost in a workout scenario. As I'll mention later, we're not talking particularly about bankruptcy situations. Bankruptcy is a court moderated process. And if we get there, there are times where that can work as a strategy, but that's not what we're here to talk about today. When you enter into a workout, it's kind of like a high stakes SWOT analysis. So you've got your strengths, your weaknesses, your opportunities, and your threats. What's typically happened at that point is your threats and your weaknesses have bubbled to the top. And now you've got to see if you can figure out what your strengths and opportunities are. The first key that I point out here is see the crisis coming. You look at your key performance indicators. Right now, as Eric indicated, we're early in the process of this economic turbulence and uncertainty. There, I said it. But yeah, exactly. You can see the crisis coming. The way I put a note on my sheet here, I've got a young driver in my family right now. She's a 14-year-old. And one of the things I'm constantly saying to my 14-year-old driver is, now you need to look further ahead. You need to look further ahead. because what she tends to do is look at what we're just going past right now. That would be my advice to both, well, to all the constituencies here, lenders, investors, distressed companies. Look further ahead and see if the crisis or the downturn or the difficult times are coming, and be proactive in your approach. The second item I would point to is know your company's financial, business, and legal situation and your priorities. And I would say in that order. So a lot of lawyers want to look at the legal side of things and legal arguments as their main priority. I would say that that's misplaced all the time, but particularly in a workout situation. So the reason you might find yourself in a workout situation or find your borrower or a company you've invested in a workout situation is primarily because there's a financial and or business situation, a challenge that's creating problems where maybe the income statement doesn't align with the balance sheet. So I want folks to be certain that they have a really good grasp on what their financial, business, and legal situation and priorities are. The third point is similar, but focused on the other parties to these situations, because there are always multiple parties to a workout. If it was just your own problem and you weren't answerable to anybody else, you would just look internally. But because in a workout situation, there are generally, there's the company, who might also be a borrower. There is at least one lender, typically, oftentimes more than one lender. In addition to institutional lenders, there are also trade creditors. And then there are investors and management and employees, everyone else. So you really need to understand, in order to work out a business solution, you need to understand the situations and perspectives of all of those other parties. Because if you're trying just to beat down and dominate and prevail over all those other parties, it won't be a true workout. And unless you have tremendous strength in your position, whichever of those positions you're in, it will lead to failure. The next item is related to the one prior, but that's identify what a successful outcome is for you and for all parties, because you really can, in many situations, get to a successful outcome. Now, you may need to redefine what a successful outcome is, because we are in a downturn, we are in a workout situation. But first and foremost, it's going to be the company at issue, whether you are the company or that is your borrower or that is your creditor or channel partner. They need to first and foremost stay in business. If they stay in business, they can maximize value and work toward a more successful solution. And last on this list is negotiate toward that outcome. So don't start out trying to win the battle as much as trying to raise all boats. The old saying, the rising tide lifts all boats. That's where you need to be in a workout situation. You'll look at your own situation first and foremost, but you have to look at the situation of the others. Okay, Ryan, we can move to the next slide. I'll move fairly quickly here. The point of the next few slides actually is to point out all of the different constituencies who have a dog in the fight or a horse in the race, right? We have creditors, both secured and unsecured. Those could be bank lenders. Those could be subordinated lenders. They could be purchase money parties, suppliers, service providers, claimants. The point of that slide is you need to know who those folks are at the front end and kind of evaluate each of those per my prior slide. Where are they coming from? What do they have at stake? They usually have something to lose. Usually everybody in a workout situation has something to lose, and most parties have something to contribute. If there's a party that doesn't have anything to lose, that is a party that could take an aggressive bull in the china shop type approach, but may choose not to. Hopefully will choose not to in many scenarios, because even if you are a secured lender and there is collateral sufficient to cover the obligation to your bank or to your company, it still may not be in your best interest to, for example, force a liquidation, because that puts a company out of business and you lose future opportunities. And so consider what everybody has to lose and what everybody has to contribute. Next slide, please. So these are other constituencies. These are people that have skin in the game, no question. So the shareholders, the employees, local communities, and regulatory authorities, those are folks that are typically in a different context or a different position than the creditors or the lenders, but they all have something at stake. Shareholders have their entire investment, and if this is a closely held business, it may be most of their net worth. So they have almost everything at risk in this situation. Employees, especially the key employees, again have nearly everything at risk, because if this does not work out, if there's not a long-term solution, they could lose everything in the sense of losing and having to start over. Local communities, as we all know, tough times right now for rural communities and for the ag sector. We have a lot of really successful companies that may be in hard times now because of the downturn in the ag economy and the rural sector. And if they fail because there's not a workout, that really bodes ill for the future of that geographic area. And regulatory authorities, they want their programs, they want to be repaid, but what they really want is job creation, wealth creation, and succession and perpetuation of businesses. So again, these are different constituencies, but with something at stake and a reason to want to work out to succeed. Next slide. The resources, again, we can touch on this fairly quickly. These are all, capitalizing a company, an operating company, sometimes is like a reverse Jenga. So you've got to fit the pieces in and make sure that you've filled the gaps wherever you can. In a workout scenario, sometimes the gaps and the gap filling starts with accommodation or debt relief from someone or from multiple someones. But the other things that happen is other people need to double down. They need to put more investment and more at stake. That can be savings, that can be family and friends, government loans, or of course external financing, which may be the parties that are already in the it could be people that are already in the capital stack or already in the debt financing role, or it could be new money. And all of those parties, again, to the extent possible, need to work together to get to a successful resolution. And then my last slide would be the next one, Ryan. Again, so you'll need to sometimes you need to look at equity financing. Do you need to bring in a private equity firm? Maybe, if there's one that will work on a workout scenario. There may be public capital available. If you're in a difficult situation where you decide a sale might be in your best interest, there might be a very successful sale to happen, or a sale of a division. And the last item that we've really mentioned that we're not going to talk about much today, but is bankruptcy. Our goal in talking about workouts is to draw a hard line through that bankruptcy alternative in most scenarios. A liquidating bankruptcy is very different from a workout. A workout, as we envision it and as we're talking about it today, is intended to be, in some degree or another, a win-win, maybe even a third win for all of the constituencies as much as possible, which if you're faced with the possibility of a shutdown or a liquidation and getting only liquidation value, that probably means all of the parties, the investors, the company and the principals of the company, and the lender, we're probably in a lose-lose-lose situation. Some might be made more whole than others, but that's not the scenario we want to talk about today. Now, there are some reorganizing bankruptcy alternatives and maybe some prepackaged Chapter 11 alternatives, which we won't get into in great detail today. But bankruptcy, at least for purposes of this discussion today, would be the alternative that we're trying to avoid. And with that, I think I will turn it over to my partner, Bill Brown.
Hey, thank you, Chris. Could you go to the next slide, Ryan? So before I start on the slides, I want to give you a little perspective that I'm bringing to the table. So I've practiced now for 43 years. I actually was a bankruptcy clerk for a federal bankruptcy judge back in law school. Kind of started out as a tax guy, but primarily work in mergers and acquisitions like Eric's firm, and have worked with all kinds of different companies, both in terms of acquisitions and sales, and also a number of debt workouts for them. And I just wanted to follow up on these constituencies thing by mentioning that one of the things you also need to look at is the type of business, because it varies dramatically what those constituencies are and how they need to be addressed depending on the nature of it. And also they're oftentimes in a different stage of their need for a debt workout. You know, for instance, manufacturing, I think, will suffer later generally than most of the other businesses, and they have to pay particular attention to their supply chain, because they have to worry about whether their suppliers are going to be at risk and may have to find other suppliers. So as we look at the constituencies, you got to look at the specific kind. Another example, healthcare. Healthcare, you know, it's going to be hard to get anybody's attention during the middle of the COVID crisis, yet all of the things that are happening that will affect them will have gone quite a bit further by the time they get focused on their particular workout needs. And as I said, it just varies based on it. Real estate is the one that really we saw the big emergence back in 2007 and 8. I think ultimately we will have it here as well, as people realize that it's a lot easier to work remotely than we may have thought. And in fact, a lot of firms, I know we're in the Ruan Center here, and there just aren't a lot of people here even yet that come to the Ruan Center for things. So I think commercial real estate will ultimately have some issues that it has to address, but those are probably a little bit later in the scene. So next slide, please. So what are the kind of substantive things that you have to deal with in the course of a debt workout? So we talked about constituencies and how they are have to be addressed and should be addressed on a very holistic approach and a very transparent approach to the extent you can. But the first thing that you're generally looking at a debt workout are the loan covenants, because this is usually engendered by a secured lender of some sort, where you have various things that are not looking so good, and you have to, your first order of business is to determine where you stand with the loan covenants. A lot of loans have financial ratios that will be blown at some point based upon the downturn in the business. They may not have been blown yet, but they ultimately will be blown, whether that's a liquidity ratio or you know, tangible net worth ratio. Any of those things can put you into default, and it's a good idea to look in advance to see and project your cash flow going forward to see how that looks. But the loan covenants are very important. There are all kinds of other covenants usually present that has to be looked at. So one of the first things a lawyer will look at is what those loan covenants are, and also what notices are going to come out as a result of this transaction and the condition of the organization. So the borrower has to look. A lot of times there's an affirmative obligation to give notice to your lender of your defaults, and your best advice to do that as soon as you identify it, because that establishes the beginning of the rapport with the lender. Most lenders really do not want to foreclose. They really truly do not, for reasons that Chris mentioned and others. They want the ongoing business. They are interested in the community aspects of it. They do have to protect their interests, of course, but once you establish that rapport by a notice to them, you start establishing the relationship that may enable you to negotiate your way out of an issue. The lender has to give notices as well. Certainly before they take certain actions, they have to give notices. And then there are other constituencies that need to know at some point in the process. For instance, you might have a company with a forgivable loan from the government on some basis. There may be notices that you have to give to them. Certainly the ones you have to be most concerned about and careful are things like notices to your customers and to your employees, because you need to keep the business together. So while while certainly transparency is really important with most of these constituency groups, you've got to be very careful as to how you handle some of them as well. Next slide. So other things that come up in the course of this are standstill requests. Well, what a standstill request is you go to the parties that may take action that would be adverse to the business, whether you're a creditor or a lender, you may want to do this, or an investor or an owner. You want the parties to stand still for a period of time simply to enable the parties to get their arms around the business, the status of the industry, the future cash flow projections of the business. It just simply takes some time in most businesses to figure out what the next steps will be. Obviously, you get extensions of payments that you would want to negotiate. That typically involves, obviously a continuation of the interest, but an extension of payment can make a big difference. And we've certainly worked out that with many, many lenders in very different scenarios. And that may get you to the point where you're back to a profitable, particularly in a situation like we find with COVID, where it's such an unusual and broad-based external event that doesn't necessarily reflect the inherent health of the business, but definitely affects the health of the business, at least on a temporary basis. And an extension may be much more viable for a party in the current circumstances than they would be in the typical business failure that's driven by things that are not external like this. And of course, default interest. Many of these loan agreements have a very punitive default interest if you're in default. And one of the things that you'll generally want to negotiate in this debt workout is to waive the default interest to enable the company to get back on its feet. With a very high interest, it may be a significant impediment to getting things reorganized. And as I say, most parties to this really have the principal interest in making sure that this thing works out. They don't want to foreclose, they don't want to go into bankruptcy, and that's why you have the ability to do a debt workout. Next slide, please. There are also some things that are kind of unique now with the COVID crisis. This force majeure provisions, otherwise known as an act of God provision. Many contracts, including some lending agreements, have these force majeure provisions that excuse performance in certain circumstances if the reason for the failure to perform is an impossibility of performance or an impracticability of performance. The real problem with force majeure provisions is that they're very specific to how they're written into an agreement. And most force majeure provisions I have seen generally do not cover a pandemic as an outside event that gives an excuse to performance. Now, even with that though, there's still some legal authority out there that if it's impossible or impracticable of performance, for instance, a government shutdown order that prevents you from performing, you may still have the ability to get at least a temporary excuse from performance. Another issue that's a big thing is business interruption insurance. A lot of operating businesses have this. It's really principally designed for business interruption associated with a natural catastrophe in the order of a fire, a tornado, a hurricane, things like that. And in fact, a lot of the insurance companies are fighting this right now as to whether or not the business interruption insurance will cover lost profits during the pandemic. And it kind of depends again on how it's written and how the position of the insurance company certainly, but that's going to be a long-term proposition to work out in most cases with an insurance company, unless it's abundantly clear that there is a a liability on the insurance. And then finally, regulatory reporting, and this is where you get into the different types of businesses. For instance, healthcare is very highly regulated, while manufacturing, as an example, is less highly regulated, although a lot of manufacturers would contest with that. But certainly there's intense regulatory involvement in certain types of businesses that you really need to attend to that and work on, particularly waivers of certain regulatory requirements. You'll see that in the CARES Act, there were all kinds of waivers of regulatory requirements, and the governors are also waiving regulatory requirements. So it's important to pay attention to those, focus on those, know which are waived and which are not. Next slide. Now, this one's interesting because tax issues. You don't normally think of tax issues being of much relevance in the case of a debt workout. You're worried about financial performance. The problem is, as you're working out your plan to get this business back on its feet, you have to be truly cognizant of these tax issues, or else your projections on future cash flow may be way off. As you incur a tax liability associated with part of the debt workout. And that's true principally for the borrower, but it also can be true with lenders if they, for instance, were secondary lenders that came in and bought debt as part of the transaction. So you look at owner loans, you look at capital infusions, conversions of debt to equity often create tax liability to the borrower. So that, while that would be a common thing to work into a debt workout, you have to look at whether there's a tax liability associated with that conversion, because there's a basic principle in tax law that a forgiveness or cancellation of indebtedness creates taxable income generally to the party whose debt is being canceled or forgiven. There are exceptions to that, and I'll get into that a little bit in a minute, but those dramatically affect your projections for how the business goes forward, and you need to really focus on that. Next slide. Okay, so the remaining tax issues, and I talked a little bit about cancellation of indebtedness income, but a reorganization in a debt workout may involve changing the corporate structure in some manner too to get there, and you need to be cognizant of the tax-free reorganization provisions. And then the cancellation of indebtedness income, the main exceptions to that income are provisions that deal with insolvency or bankruptcy. Now, insolvency is interesting, and this we'll get into briefly, at least one of our later presenters. Insolvency for purposes of the tax law means an excess of liabilities over the fair market value of your assets. So the fair market value of your assets is critical to this. And there is probably the ability to ignore going concern value of assets in making that determination. And if you fit within the insolvency exception, you don't have taxable income from the change. Now, you do have to reduce other tax attributes such as net operating losses, basis in depreciable property, things of that nature. And that's the price you pay for avoiding the income recognition. But it's generally a pretty positive thing to get in there. So insolvency is one exception. There are exceptions for farm indebtedness, exceptions for certain type of real property indebtedness associated with real property acquisition used in a trade or business that I think would be very helpful to hotels, for instance. And then you also need to look at any tax loss or credit carry forwards, because that'll affect your cash flow going forward. So those are just some of the substantive issues you're going to run into as you deal with the debt workout, and things you need to be cognizant of. And it's why it's really important to get professionals that have the breadth of experience in these things, and why business type professionals rather than litigators are the right people to get involved, because they have had over years of experience exposure to many of these different types of things. So with that, turn it back to NCP, and I think Brett, or maybe it's still there.
Right. Brett, you ready? I don't know if his microphone's working, but.
Brett, just in case you're talking, we can't hear you. It's possible.
Yeah, I just heard him. He said he's ready. I'll go get him. All right, Brett's on board. Here we go.
Apologize for that. My computer wasn't wanting to get off the mute, but Brett Peterson, Senior Vice President of NCP. Thanks, Chris. Thanks, Bill, for your comments, as well as Eric, although I will clarify per your fun fact, Eric, at the beginning, I peaked at 263, which typically is rounded down. Anyway, I'm gonna kind of just go a little bit deeper into the three different perspectives that we have referenced already today. Those being the lender, the borrower, and a third-party investor. So first, from the lender's perspective, and I think the primary lens here is really one of a secured senior lender. Is kind of the main focus here, and what they're seeking ultimately from the kind of the micro perspective specific to a distressed borrower is just kind of what is the risk and associated opportunity with that borrower. More broadly, in an environment like we're in today, in a recession or a pandemic that kind of broadens the potential exposure to an industry, even kind of on a macro level, then it really becomes more of a global bank perspective. And one of the dynamics that often is faced is really kind of one of the loan officer versus the credit officer. And so you have a situation where the loan officer typically has the relationship with that distressed borrower, and they're wanting to maintain the relationship and obviously not lose from the bank's perspective, but sometimes you can have a much different perspective at the bank level from the credit perspective, as obviously if things get worse from a macro or an industry perspective, the outcomes can be in direct conflict with that of the loan officer. Ultimately, they're trying to improve their recoveries and seeking advice and perspective on the current environment. I will say it seems like the monetary stimulus as well as the fiscal stimulus that we've seen thus far has helped, and to Eric's point earlier, maybe a delay or maybe a softening of what the potential blow could have been. And one other anecdote is that banks definitely seem stronger going into this recession or pandemic than they were from a balance sheet perspective of their own in the last Great Recession of 08 and 09. From an advisory perspective, then, our job is just to help facilitate communication amongst all the stakeholders, obviously that being the lender and the borrower primarily, but it can expand from there. But really what a firm like ours or any kind of advisor would do is come in and assess the alternatives, right? So whether that's specific to one credit, it's just an extension or forbearance or some kind of a discount potentially to the principal of the note to the borrower, that would be kind of a keep it in-house type of arrangement. Alternatively, I think Chris mentioned earlier, there's circumstances where you may look at divesting of assets or even divisions or the potential sale of the business. Ultimately, what you're trying to do is put together a list of strategies and ultimately execute on the agreed upon strategy once you've got input from all the stakeholders. Brian? From a borrower's perspective, and candidly, we spent quite a bit of time here in the last recession working on behalf of borrowers. And really what they're looking for is a solution, right? They're in a circumstance, and what they're trying to do is get out on the other side and maintain control and/or economics, and ultimately try to avoid that bankruptcy that Chris mentioned earlier that we try to avoid. And so what an advisor can do truly is act as a quarterback for the entire process, right? So on the front end, it's communication with all stakeholders again, like we mentioned before, but it's detailed due diligence, financial, operational, legal, on the kind of the lay of the land before you ultimately put together a list of options, restructuring strategies, and ultimately where an advisor can play and your advisory team can play a critical role is as on the execution, right? So once it's determined that understanding the goal is to avoid any kind of bankruptcy or liquidation type scenario with the range of outcomes that are possible, you want to take on the one that obviously is most beneficial to the borrower. Ryan? So from a third party perspective, an investor, we kind of lump these into a couple of different categories. One being financial, which really is just truly an objective third party that's looking for a return on a risk adjusted basis. And if you compare that today to the US Treasury around 75 basis points, those returns quite often start in the 20s and go up significantly from there. And it's certainly circumstance related. Strategics we would define as any outside third party to the environment when compared to the borrower and the lender, but somebody that has a vested interest in the company, whether that's a competitor, it could be a supplier or a customer or any other stakeholder, i.e. could be a state or even the federal government, depending on the circumstance. And typically a strategic is going to have more incentive to work with the borrower and the lender. And I'll give you an example. If you're a supplier to a company that's in distress, you're already behind as an unsecured creditor. You're already behind any secured lenders or subordinated debt holders that would be in front of you. And so in a situation where you understand that you might essentially be on the hook to receive zero from the supplies that you provided that distressed company, it may be very advantageous for you to work with them to potentially provide working capital for that borrower to manage through the current environment. These third-party investors can be both minority and majority, right? So if you're talking about more of an equity-like recapitalization of a business, there are certain firms, private equity firms, everybody's familiar with those, as an example, oftentimes come in on a majority basis. So that's where the old equity, the company, from the company's perspective, may be selling control of the company that they own going into the recession or the distressed environment. And so that could be anywhere from 51 or 100% of the company. There also are minority recaps that take place, and that's essentially infusing subordinated debt and or equity to buttress the balance sheet and enable the company to navigate the current circumstance and environment and live to see the other side. And again, from an advisory capacity, your team really is just set up to help you put together the plan and ultimately execute on that plan, negotiating, structuring, and closing on the agreed upon path forward. One comment here, NCP, our core business is certainly mergers and acquisitions, both buy side and sell side, but we do have a merchant banking platform that typically will look at minority recapitalizations, and it certainly doesn't necessarily have to. It certainly doesn't have to be distressed, but obviously in this environment, that may be more of what we see here as we move on down the path. Right. And again, I think just for clarity, there's an advisory component here that we're really focused on between BrownWinick and NCP today, as an advisor to the lender and or the borrower, but also you can look at this from a principal perspective, and perhaps there's some folks on the call that are looking at it from that lens as a potential investor into a distressed business. I think the key takeaway there is that your time is limited. You don't have the luxury of delay. I think it's really critical to work fast, kind of underwrite the position, whichever lens you're looking through, and to move on and move forward. Right.
Hi, everyone. I'm Zach Eubank, and I'm with NCP, and I do business valuation for various contexts. I'm an accredited senior appraiser and also a CVA. Types of engagements I work on are mergers and acquisitions, valuation, gift and estate valuation projects, litigation valuation projects, and wanted to talk briefly today, maybe 3-4 minutes, about valuation in a distressed situation. You know, I think a valuation exercise can be highly important for you know, the various stakeholders, including borrowers, lenders, and maybe third-party investors. When you go through the exercise, you can assess, you know, the level of actual distress of the company, and help set up some guideposts for further action based on for these various parties. In a typical valuation exercise, we're gonna dive into, you know, various risk factors associated with the company. You know, it's going to be a deep dive to assess, you know, whether or not the distress is based on just the current economic situation versus some company specific, really distressful underlying circumstances. You know, things like a history of asset divestitures, you know, assess the level of risk in defaulting on credit, or there may have already been some level of default. And also you look through historic revenue decline and profitability erosion over a historical period compared to the current situation. And I think, you know, along with that analysis, ideally you'd want to go through management projections of the income statement, the cash flow statement, and the balance sheet to really see if there's it needs to be pushed back on a little bit. Oftentimes, its management forecasts can be more optimistic, especially in a depressed economic environment. And so that's a key element to evaluation process that can help build the building blocks to actually apply the various valuation methods of the income approach, the market approach, and the asset approach. Typically, you'd start off with a modified discounted cash flow analysis, which is an income approach. And oftentimes, you'd model out a scenario analysis based on pessimistic to optimistic scenarios, and then probability weight those to really get a good sense of how cash flow is going to go forward. And I said it is modified because depending on where the company is currently, there may not be a terminal value attached to the income approach. Also, you're going to look at different assumptions for discount rates and probably look at, you know, what actual, you're going to look at credit analysis and ratings to assess creditworthiness. Oftentimes you'll see, as far as capital structure, that the debt will start to begin looking like equity as far as return. So it can really have differing capital structures elements to it. A market approach is not, it's very difficult to apply, especially if there's profitability issues. And oftentimes you're looking at healthy companies. So it's rarely used, and it should only be used with adjustments. Another commonly used approach is the asset approach. Here you're starting with the balance sheet and adjusting the assets up to a market value, which can be in an orderly or liquidated, a forced liquidation standard. Orderly, the goal is to gain the highest market price you can, and under a forced liquidation, it's usually auction. value that you're looking at. So I'm going to wrap up and say that I think it's important now to do the valuation exercise, just because even if your company has been appraised in the last 1 or 2 years, the value is going to be substantially different depending on economic forces, cash flow, and risk factors. Also, this can have an impact for buy-sell agreements, depending on the mechanisms present there. And it can also help address shareholder concerns. And finally, if we think that the company is distressed currently, but that there is a recovery, it could be a time to analyze estate planning and see, with the current economic environment, with revenues somewhat depressed, multiples somewhat depressed, it could be a good time to value and try and transfer based on your estate plans. So with that, feel free to reach out, and I'll let Brett and Eric run through some scenario analysis.
All right, thanks, Zach. And in the interest of time, I'll be very brief in these examples. There's 3 from the last recession, 1 from the current environment that we're in. So the first one, as an example, and we were actually involved from the third-party investors lens, and this was an example of a manufacturing company that essentially took on a pretty large expansion project, built a new facility, built an entirely new manufacturing facility. Immediately prior, I think it finished up around the summertime of 2008. So very ill-timed, unfortunately, in hindsight. So with the additional debt and burden on their balance sheet because of the new facility, as well as the impact of their business during the last recession, we worked on behalf of a third party and actually came in and bought the debt at a fairly significant discount. And we went through what's called an Article 9 foreclosure, which is a non-bankruptcy foreclosure on the business, and essentially took control of 100% of the equity. So in that instance, the old equity, the distressed borrower, was completely wiped out. Their employment was maintained. They actually kept a job post-close as well. It also avoided a personal bankruptcy, which was a potential outcome where he was headed. So that's one example. Brian. The next example, we were working on behalf of the distressed borrower, and not dissimilar. They had also completed a fairly significant expansion project that I believe closed and was completed in the spring of 2008. And then in the fall, obviously, we all recall what happened. And so the combination of their burden balance sheet, as well as the impact that the economy had on their own business, was significant. And so we were able to work with effectively all of their creditors. I believe that there was 3 primary secured creditors in that specific situation. We essentially ended up negotiating to where one of the senior creditors took a fairly significant haircut to their outstanding debt. We brought in a third-party subordinate high interest lending group to take that down, and ultimately within 3 years of that workout, our client maintained 100% full equity control of their business, and had this, kept the haircut that they were able to get from the bank during the workout process. And so this example is really one that was, I think, probably our longest term client in the last recession. We worked with them for probably around 3 years, and they really kind of experienced quite a bit of what you may recall from the last recession. Early on, it was a lot of the kind of the extend and pretend and kick the can down the road. So it was loan modifications. And ultimately, we worked through a number of their assets. It was a commercial real estate development company. It was not located in Iowa. It had some Midwest presence and greater East Coast presence. A number of different asset groups, both commercial real estate, residential real estate, land development, hotels, office, multifamily, you name it, they had it. And we were successful in maintaining their control of the development company. they certainly had to sell certain assets, and they even had an instance where they were able to buy back their own debt at a discount, which was a pretty unique deal because of some of the issues that the bank was facing themselves. Ryan? Yeah, so this opportunity is actually one that we're currently working on. So this would be kind of the more recent recessionary environment that we're facing, and this is a company in the food space that had some of their own internal issues going into the beginning of 2020, primarily labor and quality, and essentially they were getting past those, but they certainly had a balance sheet that was a little bit strapped, and obviously with that circumstance and the combination of what happened in the middle of this March, it was quite a burden for them. And so we've been navigating with both the borrower as well as the investor group to complete a minority equity and debt recap of the business, whereby the ownership group, in this case a family, will be able to maintain control of the business that they've built over a number of years, and continue down the path with a much more enhanced balance sheet.
All right, with that, Ryan, I've got a couple of, this is Eric again, and I'm going to kind of moderate the questions and answer. I've seen a couple come through. Maybe I'll take them in reverse order. But there, one of the question is, and this is a good question, is the cost of these services and the return on investment of these services. And I'll start, and then I would like to turn it over to Bill or Chris. But from our perspective, Brett went through a lot of really good scenarios, and every one of those ultimately had what we think is a fairly, in a distressed environment, a fairly as good as it was going to get outcome. But I would say minimum investments in this, a lot of it's prepaid, and a lot of times ultimately your lender will actually support some of these fees being paid. So if you think about it, you're in a stressed balance sheet, you kind of owe more than your net worth is today in today's environment. The lender essentially potentially releases funds to help subsidize or ultimately kind of pay for this process, because of the fact that, again, we look at it from a collaborative side, and what's the optimal scenario for all the parties involved. So cost prohibitiveness a lot of times is accomplished just through that collaboration. But you're looking at front end costs in the tens of thousands on the small end. So certainly you want to be at a certain scale, or need to be at a certain scale. And I think the assignment Brett mentioned, which was call it a 2 or 3 year type of long-term engagement, they were hundreds of thousands of dollars of fees into the deal, but the outcome in the operating company, where the owners kept 100% control, for example, those hundreds of thousands of dollars had an ROI, I almost want to say of infinity, because the value creation, for the distressed creditors 2 or 3 or 4 years out was literally in the millions or tens of millions of dollars. So we think, frankly, short of a kind of a sell side M&A or buy side M&A kind of healthy world process, or even equal to, the return on investment for this process is about as good as it can get. Bill or Chris, would you like to add anything to that from the legal side?
Yeah, this is Chris. I would. The thing that I think about when people look back on these materials, if they do, is look at the results of those scenarios, because by almost any analysis, and for almost all parties, those were tremendously successful. So I would describe this as very, very high risk, high value scenarios, where we talk about, sometimes people use it recklessly, bet the company scenarios. Well, when you're in a workout scenario, it is a bet the company scenario. And all of those constituencies that we talked about at the front end are at a very high risk situation. And so this sort of assistance is high risk, high value. So the advisors will need to get paid, and they'll need to get paid generally upfront, and they will try and work with the various constituents to say, what will we do and how will we make this work for folks? But again, high risk, high value, high reward. And when I look at those scenarios, I say that those are different paths to successful workouts. And so to your point, Eric, I think the return is really, really substantial. So That'd be my 2 cents worth.
And let me add one thing too.
Please.
You know, I've actually handled Chapter 11 bankruptcies. They are very expensive to do. They go on for a long time. Whenever you involve a court proceeding, it adds to the expense in a number of different ways. Plus, unlike a court proceeding where it's a cram down, it's actually a cooperative venture. And my experience has been that it's actually, since really a bankruptcy is the ultimate last resort because it's going to be the most expensive of all, and particularly to the borrower who likely is going to lose all of their equity and maybe get put in a personal bankruptcy as well. So the upside is just so tremendous, and the cost generally I think is less than in a bankruptcy setting.
There's another question which basically states, you know, how does a company decide to do you decide to fight or flight? Is it worth trying to work out? And this does depend. In some scenarios, and I'll be really candid, you know, we've looked at many scenarios in the last recession, even really some in the healthy environment over the last few years. And from an operating company perspective, the first thing we look at is gross margin. And these are rules of thumb because every business is different. But there are businesses out there that I call them kind of the walking dead. They're almost zombie businesses in a good environment. Low barriers to entry, maybe high capitalization costs, just a really commercial printing, it comes to mind. We've seen a lot of those over many years, and in a lot of those scenarios, candidly, you don't have a gross margin. You're trying to operate it as skinny as you can on an operating margin, and we kind of almost look at those as like self-employment type of scenarios. And when a business like that, again, highly competitive, low gross margin, high capital costs, for example, it gets into a stress scenario or upside down with the lenders. Candidly, and oftentimes it's really not probably going to be super productive hiring a bunch of advisors, trying to do a workout with a lender, because ultimately there might be cases where really the orderly liquidation type scenario and cooperating in orderly liquidation, may in times just kind of keep you out of a personal bankruptcy. On the flip side, the pandemic it's a terrible thing, but it's kind of a perfect example of there are businesses that are sustainable over, frankly, the last 100 years. Certainly think about some of these lodging type of companies or entertainment type, not digital entertainment, but just generally, amusement parks or something. In a lot of those scenarios, you got good gross margins, you got a sustained profitability, and in a horrible and sometimes medium-term downturn. Those are the type. That's a good example in this environment where you may be upside down, but there's a whole lot of interest, societal, lender interest, community interest, et cetera, to keep those businesses around to live to fight another day. So it's really situational, but we start with the gross margin. So anything to fight or flight, Chris or Bill?
This is Chris. I think you've sized it up pretty well. And there's another, there's an expression that I know that you folks have used, and that's sort of, are you a good workout candidate in situations you've mentioned a misalignment between the income statement and the balance sheet? And I think maybe I'll give it to you guys to explain that concept, because I think it's very helpful to people to understand if that's the primary disconnect, that you've got a good balance sheet, but the income statement isn't where you want it right now. You probably are in a fight scenario. In other words, don't give up, don't file for bankruptcy, don't shut the doors. Try a workout. Maybe you guys could talk about that disconnect between income statement and balance sheet.
You bet. Go ahead. Brett's going to take this.
Yeah, and Chris, I think Eric tried to touch on that a little bit with for example, with gross profit margins and some of when there's low barriers to entry, oftentimes those companies with a tough income statement going into a recession environment are going to have a hard time getting out. But I think along those lines, it's important that from a lender perspective, they typically are looking at collateral and some cash flow, but primarily it's collateral. But if you have a strong margin profile and just are experiencing something like we're looking at right now that may be prolonged, but it may be more acute in a quarter or two, That's where strategic type third parties might be a really good resource for you, because if there's a great underlying business with just a kind of a broken balance sheet in the current environment, that's where maybe it's a minority recap or a subordinated debt type of recap. That would make some sense. And again, when I say strategic, that could be a competitor, but it could also be a supplier, or even a customer, or some other kind of vested stakeholder.
And Brett, Chris, I might jump in on the tail end of that.
Go ahead.
What I might say on the tail end of that is, one thing that some of the folks on the call might be worried about is, okay, I think I'm in that scenario, but I don't know who those people are or how to find them. I think I'm hopefully teeing up a softball there for NCP, but maybe you guys can describe that aspect of what you do for a good business, but that they don't know somebody with, bags and bags of money.
Yeah, and I'll give you thanks, Chris. That is a great one. I'll give you an exact example. We've been in a scenario, very much a kind of a branded company, long-standing reputation, got into some issues with suppliers, and kind of through a growth strategy, changing over some technology, where they had some real quality issues, and it put some of their customers at risk. And you mess with that for 12 months in any operating business, and you can kind of get upside down or pretty tight with your creditors in a going from a high equity position to a low one, in a span of 12 months can happen really before you know it. And in this scenario, what we were able to do with this company, and it might have not been the optimal time, but the outcome was really, really good. We were able to say, oh man, we recognize this brand. We think a lot of their potential competitors and strategics do, and as well as a supplier in this perspective, really recognize the fact that these were operational issues. These were surmountable issues. We ended up going through a successful, abbreviated, very, very tightly knit, I'll call it, kind of a very rifle approach M&A process, and where the lender was really looking at, but literally at best probably a Chapter 11 kind of reorg workout. We ended up selling to a strategic for quite literally a gargantuan amount of goodwill, because we had the right two or three strategics in there. They recognized the value of this brand, the value of this product set, and I'm kind of surprised the lender didn't write us an additional check for an extra few $1 million when that was all said and done, because they were paid out money good, with interest. The family, ended in a great place as well. So even when it looks really dark, there are definitely scenarios where there could be substantial goodwill values. And candidly, lenders, this is not really what lenders do. That they're not M&A professionals or multiple professionals, or kind of understand that stabilized and adjusted EBITDA. They kind of understand it, but it's not what they do. And so that's where we would caution sometimes for a lender, whether it's a borrower or a lender, to talk to people like us at times, or in that type of scenario, because we may literally be able to find value where things look pretty bleak. That's, I guess, in closing, Bill or Chris, do you have anything you'd like to kind of leave us with, or thoughts, or what have you?
This is Chris. I've got about 3 quick comments, and then I will be quiet. But a couple of things that come to mind for me. When you're in a workout scenario, you gotta take a glass half full kind of approach, with full energy, and you can't be sheepish or apologetic. You've got to go find your champion in both your service team and in the parties that are going to help you work out of this. Sometimes that's why third-party representation helps so much. On the flip side is you've got to be realistic with yourself. So if you've made mistakes, or if your borrower has made mistakes, if somebody in the chain has made mistakes to end up where they are, that doesn't mean this will work out or it won't work out. That just means that's how you got here. Sometimes nobody made any mistakes, and it was just because of, in this case, COVID and the related recession. It's important not to look for anyone to blame, but instead to look for the rainbow, because if you're a ripe candidate for a workout, you got to look for the win-win scenario. So that's kind of the last ray of sunshine from me, but that concludes my comments. I'll turn it over to anybody else.
Bill, you got anything?
I would just say that, keep in mind, no matter where you stand in this scenario, whether you are a borrower, a lender, a supplier, an executive within an organization, I think any of the constituencies can benefit from getting outside consultation on this from professionals who have experience in doing this. Even in some cases, you might even hire a mediator to handle certain sort of disputes that exist. Mediators have skills to bring people together in ways that, certainly litigators are not experienced in doing. So there's always a place for someone, and NCP in particular, being a quarterback behind the scenes on all of this can be a very helpful process. So that's all I would say.
Well, we appreciate that. And I guess the thing I'll leave this with too is I look at stressed business scenarios. Like, I've never met a really successful business, which is, where we like to spend our time, who doesn't, that hasn't gone through some real stressful times. And frankly, in a lot of cases, maybe a workout or two before they became that ultimately really successful business with that really successful liquidity event. So I think you're in really good, I think you're just in good company. Things happen. And I look at the workout restructuring process as almost like kind of a long-term health issue. Maybe it's like a skin thing. It's or whatever the case may be, a knee. Typically, the longer we wait and kind of sit in that denial stage, like, man, my knee's tweaked, but it'll be all right, or there's something on my leg, and I'm not really sure I want to check it out. That can be really catastrophic in both a healthcare scenario as well as from a business side, kind of a business continuity scenario. So I think it's really important to whether it's an NCP or certainly with your attorneys with BrownWinick, pick up the phone or do a sit down or whatever whatever you're comfortable doing these days, and start to have some discussions, because you got a lot of people that have been through this a number of different times. And I'll just go back to it. I think this is one of the highest ROIs from both the legal profession, as well as the financial advisory profession, as far as what people kind of get for their time and treasure. And the earlier you kind of get to this and start to kind of formulate that plan, you kind of get past that denial, anger, kind of work through those things. Really, way more often than not, the better the outcomes. Most people have been there before, and kind of picking up the phone or making that call is it's the right thing to do. So I guess on behalf of all of us, the presenters, Ryan and Jess helping putting it together, and certainly the participants on the call, we really appreciate it. Love to hear from you. Any questions, whether it's investor side, lender side, borrower side, you name it. But we appreciate your time today. This will be recorded. I think Ryan will send something out after the meeting to where, if you want to pass this along to others, feel free, by all means. The slides are all at your fingertips. So that's all I have. Ryan, you want to close it, or are we good?
I'm all good. Thanks.
All right. Thanks, everybody.
Thank you, everyone.